Welcome everyone. I'm here today with Lucas Goode, who covers Ampol for Investors Mutual. This is a stock that we've owned for some time, and really I think it represents really interesting opportunity in the current market. So today we just want to talk a bit about Ampol and explain why we like it and why we think it has the attributes that really suit our portfolios. I think at the outset, Lucas, it's been one of the most successful rebrandings I've seen to move from the branded fuel retailing business of Caltex. Rebranding the companies as Ampol, I think, has really reinvigorated their retail network and really given birth to the new Ampol that we see today. But look, I think you know the assets very well. You've been following the stock for some time, so I think maybe just sort of at the outset explains why we like the business, and why I think it's well positioned going forward.
Thanks, Simon. So I think the first thing to highlight is that, for us, where the market sees a sunset industry entering a period of potentially terminal decline, which, interesting view given Ampol actually reported record annual profits less than 6 months ago, we see irreplaceable strategic infrastructure and an increasingly attractive industry structure at the same time. I mean, one of the great things about a perceived sunset industry is that it discourages new entrants. And so we've seen this market become increasingly consolidated, both on the retail side and on the wholesale and commercial side, with the big three players of Ampol as the largest, BP and Viva Energy controlling more and more of the market. And that's resulted in stable and growing retail fuel margins and stable and growing wholesale and commercial fuel margins, even as volumes continue to rise despite what the public may think.
Yeah, I think it's important, Lucas, to understand that the business of Ampol is not just the retail business. It's the infrastructure, the terminals, the pipelines, the trucks, the trains that move fuel, highly flammable material, which is a valuable asset around the country.
That's absolutely right, Simon. And Ampol's got 100 people sitting in Houston and Singapore that do nothing except trading cargoes, making sure they're getting the best prices for their products that allow them to eke out more of that margin. And again, it's just a footprint that's almost impossible to replicate, especially now they've also got Z Energy in New Zealand.
Yep.
And I guess another thing to touch on is that, refining previously was seen as a real negative as part of Ampol. It was one of the things people didn't like about owning the business, was you had this volatility of earnings. But actually, it's become something of a one-way bet.
Yeah, and I think that's an important point because I think people have missed the fuel security levy and the implications that's had for the industry. So we did have 4 refineries in Australia. We now have 2, one run by Viva, one run by Ampol. And the government have put in place a fuel security levy, which means that when those earnings are volatile and when they go below cost of production, the government steps in and pays Ampol to ensure that earnings stream isn't a burden to shareholders of Ampol. I think that's really important because that is that volatility, I think, before you rightly point out, which caused noise in the profit and loss statement and the cash flows, which kept investors on the side. So I think it's really de-risked it and puts the business in a much better position going forward.
Yeah, and the great thing about that refinery still being open as well, Simon, is not just that, clearly, as we've said now, losses are somewhat mitigated, and you do sometimes get these areas of super profits like we saw last year with Russian invasion of Ukraine. But also, strategically, it's enabled Ampol to carve out a much bigger share of that commercial market because BP and Mobil don't have a refinery anymore, so they can't provide the same downstream supply that Ampol is able to supply. And look, I think even just going back to the retail side, we remain of the view that decline of hydrocarbon usage is going to be a lot more gradual than, maybe people might think if they happen to live in a suburb where everyone's driving a Tesla. Because actually, the majority of Ampol's fuel volumes aren't going into passenger vehicles at all. We're talking about aerospace, we're talking about marine, trucks, heavy vehicles, the mining industry. These are all going to be major sources of demand for a long time to come. And, even on the retail fuel side, Ampol's unparalleled service station network is actually a great strategic asset, even in a world where more and more people drive EVs. And the example that I'd point to is actually Norway, which has the world's highest EV penetration. I think it's about 80% of new vehicles, might even be more than that. And yet the number of service stations in Norway hasn't changed over the past decade. And actually, service stations are more profitable than ever because it turns out EV customers, they visit more often and they spend more while their car's charging than their petrol-powered counterparts. So, the EV doesn't have to be the death of the service station whatsoever. And what it does highlight is the value of that high-quality, high-margin convenience retail offering, which Ampol, it's still got some way to go, I think, to get it just right. But, we've seen the value of these assets with Viva buying on the run for a very high multiple relative to Ampol's current trading multiple. And we also actually saw it with Couche-Tard, which is the owner of the largest petrol station network in Norway, offering $38 a share for Ampol in 2019.
Yeah, I think it's a great source of frustration for shareholders in terms of where the stock price is today at $33. It's well below the $38 that Couche-Tard bid back in 2019. which is either paradoxical or frustrating, given that Ampol is actually a significantly larger business today, having bought and integrated the Z Energy business without raising any equity. So the business profitability is much higher than it was previously, and yet the share price still trades at a discount to that takeover price. So we just think, current multiples less than 12 times, yielding 6% fully franked on an EV/EBITDA multiple of 6 times. The business is very attractively and cheaply priced, particularly in a market where a lot of other stocks look pretty fully priced. Particularly, I think, given the nature of the business has been, I think, de-risked to an extent, and much more stable and very cash generative.